And so I think it's very important. Yeah, the banks are on shaky ground, basically. If you look at just before the crash of 1929, the same thing had happened. And fractional reserve lending works in reverse also. As people take cash out, the bank's balance sheet gets worse and becomes more tenuous. And they have to, loans that automatically roll over, they have to stop rolling over those loans and contract their loan book to match the reserves that they have. And so that's exactly what happened in the Great Depression. And since there's a reserve ratio, if the banks have, if the reserve ratio is 10 to 1, they're allowed to make 10 times more loans than the cash that they have on hand. If customers come and withdraw half that cash, they got to roll back the loan book by, you know, it's a 10 to 1 ratio, and they got to unwind that in the opposite direction. That was devastating during the Great Depression and caused that great contraction. This time, though, what they do is they just say, well, the banks are insolvent, we're going to take all the depositors' cash and give it to the banks, and therefore they're solvent again.
Well, and it's really insightful hearing you talk about this, sir. And of course, I've tried to go into a few times the fact that between, I believe it was September 11th, 1929 to October 25th, 1929, we saw it hit all-time highs, and we saw it start to dip, and, you know, volatility and a lot of uncertainty and doubt. And of course, we know what happened next, and today we seem to be living in a somewhat similar time with the Dow and the Nasdaq. And I was wondering if you could quickly just go into you know, the current state of the stock markets and whether you think that we are close to what they call doomsday, because I know the fundamentals are off the table due to the level of manipulation. However, we can't put a date on it, but we know that something's about to happen.
Well, with all the liquidity that had been pumped into the system, we can see the stock markets continue to go up for a little while. But if you look at their trajectory, this is very similar to 29, to early 29, when things were just, I mean, the whole nation was having this huge party. And the markets, you know, this recent crash is nothing but a correction. The Dow Jones didn't even hit its 200-day moving average. The S&P did, but every market has to come back to the 200-day moving average. What worries me is the day when all of the key indicators turn negative and all of these funds that use computers to do all of their trading all start going negative at the same time, and that causes the markets to go down further, which makes it even more negative. And so it'll be this cascading effect that's going to be lightning fast because of all the computer trading that happens these days.